In this lecture, we're going to talk about how do we prepare financial statement. So we're going to talk about the closing process. The closing process zeroes out all revenue and expense accounts in order to measure each period's net income separately from all other periods. So what we do basically, revenue and expense. So I will make two accounts. Revenue always have a credit balance. So this is the credit side and the debit side. So they will have a credit balance. And expense, all expense account will have a debit balance. So they will always have a debit balance. So what we're going to do, we make two accounts. We're going to make a new account, income summary. So let's make another one, income summary, and it also has a debit and we also have a credit. So what we're going to do here is we're going to say debit revenue. We're going to debit revenue and we're going to credit income summary. So we're going to say, suppose your revenue was $1,000 and your expenses were $800. All right. So you're going to say debit revenue, and because you have a credit balance, so you're going to debit $1,000 and you're going to credit income summary for $1,000. So you're going to put credit income summary for $1,000. Then you're going to make another one. You're going to say debit debit income summary for $800. And you're going to credit expense for $800. So what is going to happen here, you're going to, when you doing the debit $1,000, that will cancel out this account. And when you do the credit expense $800, this will cancel out both accounts, but they will put over here, and that will give you $200, and that would be your net income. So this is basically the process. So temporary accounts relate to accounting period that are closed at the end of the period, such as revenue, expense, income summary, and dividend accounts. And permanent accounts move to a next period. Closing entries transfer revenues, expense, and dividends to retained earnings. So these were the transfer of entries. Revenues and expenses may be transferred first to an account titled income summary, which we did over here. And then these transfers, so that's net income, then will go to a retained earning account. So here is a retained earning account. So you have a beginning balance, say 500, and then you add this net income over here, $200. So you have a total $700 available. You pay a dividend of $100. So your ending balance turns out to be $600. Using a worksheet. Sometimes we use a worksheet program such as Microsoft Excel may be used to facilitate the adjusting and closing process. You can do that, and other accounting software such as QuickBooks and other high-end software also provide this information. You do not have to write this thing down. They do it automatically for you. The worksheet is a tool. It is not part of the formal accounting records. Okay. How could a worksheet help in preparing financial statement? As we have seen previous chapter, that the first 4 sections of the worksheet help determine the adjusted trial balance for which we prepare financial statements, prepares the account for the next period, and temporary accounts are zero out at the close of accounting period in order to start afresh in the next period. So let's explain to this. The balance in these accounts are transferred to retained earnings. A permanent account, dividend are also close to retained earnings. Temporary accounts are revenue, expenses, dividends, and the permanent accounts are asset, liabilities, stockholders. So it steps to close the books, debit each revenue for the amount of its credit balance, and credit retained earnings for the sum of all revenues. Okay, that's another way of doing it. And then credit each expense amount for its debit balance and debit retained earnings for the sum of all the expenses. Credit the dividends for the account for the amount of its debit balance, and debit retained earnings for the same account. As we said earlier, the closing process zeroes out all revenue and expense account in order to measure each period's net income separately. Temporary accounts relate to accounting period are closed at the end of the period, such as revenue, expense, income summary, and dividend accounts. Permanent accounts are not closed, make sure at the end of the period, such as asset, liability, and retained earning. They just become the beginning balance for the next year or next period. Closing entries transfer revenue, expense, and dividends to retained earnings. Revenues and expense may be transferred from first to an account titled income summary, which is a temporary account that summarizes the net income or net losses of these accounts. The process is intended to achieve a more accurate picture of financial position by adjusting balance sheet accounts to show unexpired or to cost or up to date the amounts of obligations. Allocating assets to expense to reflect. So for example, recording supply. So for example, you have this supplies account, right? You start the beginning balance with 500. During the year, you made a purchase of $5,000. So you have a total available to you is $5,500. But ending balance of this account is 700. So what happened? You start with 500, you purchase 5,000, you have a total of 5,500, but your ending balance is for 700. That means $4,800 of supplies is used up. So something is used up is become an expense. So in order to correct this account, you're going to say debit supplies expense for $4,800, and you're going to credit the supplies asset account for $4,800. So this is called adjusting entry. This is the adjusting entry to adjust so the supplies expense account will go to the income statement, and the supplies account will be in the balance sheet. So so that's what we are doing in these 2 points. Then there is a post trial balance. What is a trial balance? So let's talk about a trial balance. So in a trial balance, you put all these accounts. So there is a heading for account, and then there is a debit and there is a credit. There are 2 columns. So basically 3 columns. So first you put all the asset account. So what are the ending balance? So ending balance goes here. Suppose the assets ending balance is 5,000. Then you have liabilities. So ending balance of the liabilities. So asset always have a normal debit balance. So that's why it's under debit. Liabilities has a normal credit balance. So suppose they have $2,000 of credit balance of liabilities, and equity has $1,000 of credit balance. Then you have revenues. All the revenues, suppose you have $3,000 of revenues, and then you have expense. So the credit side and the debit side should be always equal. So 2 plus 3 plus 6, so $6,000, and then your expense will be $1,000. So you have $6,000. So once you have the trial balance is equal, means it's now adjusted or correct, then you don't have to do that. You just move this information, asset, liability, and equity into a balance sheet, revenue and expense into the income statement. If these accounts are not same, then you have to do an adjusted trial balance. Okay. So a post-closing trial balance ensures that an equality of debits and credits, which is right here, that we have done these assets, debits and credits are same, has been maintained throughout the adjusting and closing procedure, and the general ledger is in balance to start the next period. Only balance sheet accounts appear in the post-closing trial balance. Dividends, depreciation, expense are temporary accounts that should have been closed and should not appear in the post-closing trial balance. So this is not a post-closing trial balance, it's just a trial balance. A post-closing trial balance is prepared once the temporary accounts have been closed to retained earnings. Preparing a post-closing trial balance, the accounting cycle ends with a post-trial balance, and from there we'll list all the accounts after generalizing. So accounting cycle is basically the process by which companies produce their financial statement for a specified period. It is the steps that are allowed throughout this time period, and it starts with the beginning assets, liabilities, stockholders' equity count balances left over from the preceding or previous years. Reversing entries are special journal entries that ease the burden of accounting for transaction in the later period. It is the opposite of adjusting entries, not required by GAAP and used for convenience and to save time. Quality of accounting numbers, the degree to which a company's financial statement reflects its true financial condition and performance. The true is the most important word here. Accrued accounting involves many estimates and judgments. Analysts judge how conservative or aggressive the estimates are. Conservative is good. Aggressive is bad. The more conservative the estimate, the higher the company's quality of earning is to be. Okay. So this is our chapter 7. This is divided into 3 lecture periods. Please let me know if you have any questions regarding these